Ladies and gentlemen, good morning. We'll start our review of the week and what to expect with the 10-year note. As you can see on Friday, even though we had every excuse to break higher in yield with those numbers, and I mean the average earnings, we actually did a doji, which is a big sign of indecision and could be a reversal signal. The 200-day moving average is still pointed slightly lower. So we would really not be surprised to see a shortened week, which trades anywhere between, call it 225 and whatever the top was on Friday, about 238, 239. And this, we think, is going to be a wonderful opportunity to buy straddles because we are approaching a period of very high volatility into year end. Longer term straddles we will be looking to buy. We think the market will not close the year within 30 or 40 basis points of this area. Either it's becoming very black and white. Either the Fed hikes aggressively and the market begins to realize that inflation is back, in which case we'll probably be somewhere around 3% or even slightly higher than 3, or something very bad happens and we will be somewhere around the 180 area by the end of the year, and possibly both. Quite possibly both, and we shall show you in a moment why we think so. As you know, it has been our contention for quite a while that we are approaching a major top in equity valuations. We are now at well over 115% of global GDP valuation, which probably gives us an overvaluation in excess of 25% in the equity markets. We will revert to mean. It's just a question from where, from what price, and when. It's not a question of if at all. So what we've been doing is we've been working on the average behavior of the market at major tops. And what we have come up with is that what we have to look at are actually the drivers of the internals of the SPX. At the moment, you can see that the SPX is trading far too quietly. There is absolutely no volatility. It's a very orderly market. It's a very orderly uptrend, and that is what we have to shake out. We have to shake out and receive a last big push towards a level. We have to have a disorderly market, which actually makes volatility pick up and then increase as the market turns. We have not seen that, and that is what we're waiting for. But in the meantime, we've been looking at the key drivers of the of market behavior at the top, and we can share with those with you now. One of the key drivers that we've observed in 1987, in 2000, in 2007 is that always the market spikes the monthly Bollinger Bands before it reverses. This month, those are up there at 25.95, and probably by the time the market gets up there, they'll be closer to 2600. So the market always manages to touch them before reversing back down. And that is just the sort of disorderly market that we need to get the last shorts out and to absolutely make everyone believe that the market can go nowhere but up. We obviously sold far too early around the 25.15, but again, the difference between 25.15 and 2600 is only like 3%. So we're certainly not going to cry over a 3% when we're expecting a 20% move down from those highs. Having identified the key drivers, which are XLI and XLF, Let's look at the targets in those and see how they match up with a potential top around the 2595 to 2600 level in SPY. There is no doubt that XLI and XLF have been key drivers throughout this rally lately, and now we have a Bollinger Band, a monthly Bollinger Band around 73.53 for the XLI, and we can actually see now what that is for XLF. The XLF Bollinger Band is around 27.45. Let us see now how these levels compared to measured targets from Elliott waves for the last and fifth wave. It is obvious that these are 5 waves up, and we're looking for exhaustions of the fifth wave in both XLI and XLF. And here we have a price objective chart for the XLF. If we are correct in all the counts, we have an ideal target of 27.23, which matches very well with a potential extension all the way up to 28.44. Those are about as high as we can see these XLF go. This initial target marries very well with the monthly Bollinger Bands, and that is what we would expect around a 27.25 area for XLF. The same chart for XLI, the industrials. We're quite impressed how this is matching up with the first wave, and if we zoom in, we will actually see that the ideal level is 73.75 with potential all the way up to 76.33, but which is very unlikely. We are looking for a ideal target of around 73.75. 73.75 would actually match very well with the 24.95 level in S&Ps. So if we take that the key drivers go up between twice as much and 2/3 as much as the SPX, we will get our 2480 to 2580 to 2580 2600 2585 2600 level in S&Ps, given the drivers of XLF and XLI and their ideal targets, which we have indicated to you. This will all be in the crib sheet, and those are the levels that we think we can really start buying straddles in, mainly in SPX, XLI and XLF. Those would be very, very interesting levels to get long of both volatility and straddles. Why do we keep banging on about volatility? Because what we are expecting is a market which corrects something like this 1929 to 1987 to 2017 fractal. We're not looking for these fractals to tell us that we're going to get a crash, but we are looking to them to see the typical market behavior after a top has been reached, and what kind of percentage fall or market move we can look forward to. Everybody will agree that we are at the tail end of some very abnormal market behavior. Actually, we don't know that we're at the tail end, but we know that we are in some abnormal market behavior. Trading 120-130% of world GDP at the current valuations for stocks is not normal. Those excesses are always corrected unless it's different this time. And it's not different this time. So if we just match the behavior of the market in 1929, 1987, and now, we can see some very pronounced similarities in the price action before the top was reached. And every time the top was reached, we had the same market action. We had a failure at a push towards new highs, and then we had a very rapid unwinding of all the excesses that we had in the last leg up. Well, what would that mean if we just compare those size falls? What would that mean now? That would mean a move from around 23,000 or just over in the Dow towards 16,000. Are we going to get that? I have no idea, but it just gives you an idea of the move that you could get and how volatility and options are by far the best way to play that move at around the 23,000 level in the Dow, which is roughly the 2585 to 2600 level in the S&Ps. It is amazing how all these markets are beginning to match up. This is a cash chart of the DAX, and we now have a target around 13,500 for the from this pitchfork and from the Bollinger Bands on the monthlies. We certainly think that the S&Ps and the DAX have now aligned, allowing for substantially higher prices in the DAX around the 13,600 level. Exactly the same thing can be said for stocks. We are now on our way to a blow up level around the 3,700 to 3,800 level, and we could achieve that really quite quickly this month. These are the targets: 3,700 all the way up to 3,836. It will be a quick and brutal move. Obviously, we are in for a period of quite interesting volatility. In spread land, there is absolutely nothing which is warning of an impending risk-off period. Apart from a very minor one, corrective. Here we have XLP, XLY still making new lows. SPY, TLT making new highs, risk on. And even the most aggressive, which is SOX over the yen, new highs for the year. Risk on in absolutely every indicator, spread indicator that we can see. Naturally, can it come back down towards the 180 level? Can all of them correct slightly? Yes. But if they do, it's a buy. We need a blow off in all of these indicators. We might be starting to get it, but we're certainly not at the end of the blow off. We're nearer the beginning than the end. And here we are at the biases for next week. We really want to get longer volatility in both European and US markets, mainly in the US fixed income markets. We think there will be moves both up and down, which volatility in the options is not discounting. There is still nothing in commodities that should concern anyone, and this is our conclusion, that we are not seeing any measurable increase in volatility, and therefore the top must be several percentage points away as yet. The spreads are behaving very nicely. They are still indicating risk on. They're indicating that any move towards risk off is going to be corrective, and therefore we are quite confident that we have not seen the top for several percentage points as yet. Nothing doing buying the VIX on dips is at best making you one or two ticks, which is not what we're looking for, that tells us that we are still some way away from the the expected return on VIX long of calls and long of futures. European equities, we still prefer those to the US with the hedge dollar. The dollar again disappointed. It could not sustain the highs on Friday, and it looks increasingly like we have seen even possibly the top of this wave. We're still going to hold on for the 95.07, but it's increasingly looking like the dollar cannot cut it, as we say. We still love this butterfly. We think over the course of time it's going to make a fortune, but here we are at the drivers of SPX, XLF and XLI. The objectives are here, 27, 23 and 73, 75. Those are the most reasonable objectives that we should see in those, and they could give us the 25.95 and the 23,000 level in the Dow as the tops. We will certainly be tweeting away as of after the holiday and indicating when we reach those levels and when we start buying volatility in fixed income. We think that's going to be a wonderful trade. Thank you so much and have a lovely weekend.